Traders dumping Treasuries after this jobs report came in much better than expected. With more on the bond market reaction, I want to bring in Kevin Flanagan. He's the fixed income strategist at Morgan Stanley Smith Barney. And I had to do, Kevin, a double take because the 30-year bond is really being taken down. It was almost off by more than a point. Why is there so much selling going on the longer end of the curve?
Well, I mean, we're sort of calling it a trifurcation of what's happening with the Treasury yield curve. And to answer your question, at the back end, you got two things going. First, this is where we're going to probably see the least amount of buying by the Fed in the QE2 program. Yes. And the second part, you know, if we do see better economic numbers, the Fed's probably going to still buy $600 billion. So you are going to see an increase in inflation expectations. The bond market's the most vulnerable to that.
What makes you so sure that the Fed's going to keep buying that $600 billion? We just had Nairman Barovich say that, look, there could be a possibility that they don't do that.
You know, I really, at this stage of the game, it's just one employment number. I think the Fed gave us the dual mandate. Inflation, that's the big part of the equation. If you show me in a few months that, say, core PCE or core CPI is rising, then maybe you change the game. But otherwise, 9.6% unemployment, Fed's still going to be disappointed.
But does this raise your inflation expectations, Kevin?
Yeah, it can raise expectations, but for the Fed...
Your inflation expectations.
Yeah, but the Fed needs to see it in the actual numbers, and that's going to take time.
Okay, so right now then, how would you say the mood in the bond market would be after these jobs numbers?
Well, you know, we're going to trade off, as you mentioned, as we're seeing. You know, I mean, yesterday all the talk was, well, when are we going to see QE3? So we're going to go back and forth now with
Wait. QE3?
Oh, yeah, QE3.
We haven't even gone through QE2.
I know. That's what happens. The Fed is sort of like, you know, addicting the market to these asset purchases. So
who's talking to you about QE3?
Well, you've seen it in a variety of different commentary that I've witnessed on your own Bloomberg Newswire services.
Okay, all right. My fault. I'll have to go look through that. But QE3, why are people that worried about inflation that they're now talking about more stimulus coming from the Fed?
Yeah, well, you know, I think everyone feels that QE2, $600 billion, won't be enough to satisfy the Fed, and that ultimately you're going to need to see $1 trillion at a minimum in this program.
Okay, so, all right, well then, moving on from that then, what about the bond market reaction next week? I mean, as we settle down from this jobs report, what is the focus going to be on then?
Well, remember, you know, we're going to get the new cycle of monthly indicators, and we have supply, 3, 10, and 30-year. That's probably going to weigh on the market a bit as well. So it's a back and forth here, I think, as we try to digest what the Fed may or may not do in the future, and then deal with each economic report as it comes in.
So am I hearing from you, Kevin, more volatility, not less?
You are hearing certainly a more volatility going forward. Absolutely.
Okay, and that's completely different from what the Fed was trying to do when it started QE2 early this week.
Yeah, I think so. I mean, they have been successful. Risk assets have rallied. Commodity prices have rallied. But now, you know, what happens to rates? Can they sustain these levels? It's going to be a tug of war.
Okay, and you're still going to see the same movement in the longer end that's going to be different from what you're seeing in the intermediate then? Yeah,
I think so. I mean, 10s, 30s spread, that's going to stay, I think, at all-time wides, if not even widen out a bit further from where we are right now.
Okay. All right, Kevin. Good to talk with you. Appreciate it with the bond market reaction. Kevin Flanagan, the fixed income strategist at Morgan Stanley.